Hello and welcome. This is the first lecture video for Chapter 10, which starts on page 214 of your course pack. And in this chapter, we're going to be talking about plant assets, also known as PP&E. Okay? So, in this lecture video, I'm going to give you an overview of plant assets. We'll talk about the definition of plant assets, the characteristics of plant assets, and also the cost determination for plant assets, and then do a few quick check problems, okay? So let's go ahead and get into it. So plant assets are tangible assets. What does that mean? It means you can touch it, right? So a building is an example of a plant asset because I can touch it. You know, a truck is another example of a plant asset. Land is an example of plant asset. It has to be tangible, meaning that I can touch it, okay? And they're used in a company's operations. So that's the other key thing, is they have to be used in the company's operations to generate revenue. All right, so what this is saying is I could have a laptop, for example. A laptop is a plant asset, okay? Now this laptop, if I'm Dell Computers, this laptop, if it's used in company operations, that means it's used by the CEO or the CFO or the CIO or even the office admin to do their jobs. It's used in their company operations, is used to help them do their jobs. If that's the case, that laptop is classified as PP&E, as a plant asset, okay? PP&E, plant, property, and equipment. Plant assets, fixed assets, all different names for the same thing. Okay, if it's used in company operations, it's classified as a plant asset. But we're talking about Dell Computers here. Dell Computers also has laptops that they sell. The laptops that they intend to sell, that's merchandise inventory. The laptops that they intend to use in company operations, that's plant assets. So whether it's used in company operations or the intention to sell it makes a difference on how you classify it. Okay? So it has to be used in company operations to be classified as a plant asset. It also has a useful life of more than one accounting period. And remember, we've had those discussions before. What do we mean by accounting period? We're typically talking about 1 year. Okay? So it's used for more than 1 year. Is a building, you know, I'm in this classroom building, Woodard. Is this going to be used for more than 1 year to educate students? Yeah, absolutely. So this building, it would be a plant asset for Mary Washington. So we talk about some of those characteristics in this figure. I've kind of already talked about that. So it's tangible in nature. It means you can touch it. It's actively used in the company operations. So it's used to generate revenue. It's used by the CIO or the CFO or the office admin to do their jobs on a daily basis, used in company operations. Expected to benefit future periods. That means it has a useful life of more than one accounting period. Does this classroom building, Woodard, are we expecting this to generate or to be used to educate students in the future? Yeah, absolutely. So it does have expected benefit for future periods. And then it's also called property, plant, and equipment, also known as fixed assets, okay? So that's what I was saying over here. Some of these bullets down here on page 214, plant assets used in company operations. That's what I was saying there with Dell Computer, for example. Dell Computer could have laptops that they are holding for sale, that they intend to resell to the public. That's merchandise inventory. But if it's a laptop that's used by Michael Dell, and I can't imagine that the CEO of Dell would be using a laptop from Hewlett-Packard, their Dell computer, they're going to be using a Dell laptop. That laptop is plant, property, and equipment. Okay. Let's see. Plant assets have useful lives that extend more than one accounting period. I've kind of talked about that. That would be different than supplies, which would be like Post-it notes, for example, or pencils that would be typically consumed within that accounting period. So plant assets, think about a classroom building. Think about a truck. Think about even my laptop. My laptop, you know, that I have, that I'm using right now to record this lecture video, I've had this since 2012. This goes across many accounting periods. Okay? So we can view plant assets as prepaid expenses that cross several accounting periods. And so what we're going to do, just like what we did, if you think back to chapter 3, when we did some of those adjusting journal entries for prepaid insurance, when we bought prepaid insurance or prepaid rent for multiple accounting periods. And what we did at the end of the accounting period is we had to debit insurance expense, credit prepaid insurance to recognize that 1 year of that insurance policy has expired, and now that has become a cost of doing business. Why did we do that? Because of the matching principle. We're going to be doing the exact same thing here with our plant assets, where we need to match the cost of those assets against the revenues that they generate because of the matching principle. This right here is depreciation. And I'll write that down. That is depreciation, and that's something that we'll talk about in subsequent lecture videos. Okay? When we talk about the cost determination, so remember, this relates back to the cost principle. So when we purchase a building, right? We're going to purchase a building or purchase a truck or purchase a laptop. When we buy that, let's say we're going to purchase a truck, we debit truck and then we credit cash. Or let's say we're going to buy a building, we debit building, which is an asset, and then we credit cash. So one asset goes up, one building, another asset, cash, goes down. Okay, so we put it up on the balance sheet, and then what we do is at the end of the accounting period, we do a journal entry to recognize depreciation expense, debit depreciation, credit accumulated depreciation, and we will go into that more detail in future lecture videos. But when we buy the building, we have to put it up on the balance sheet, debit building, for the cost of the building. Not the tax assessment, right? Not what the seller thought it was worth, right? It's what the buyer, us, what we bought it for. Why do we have to use that number? The cost. Why do we have to use the cost? Because of the cost principle. Remember, the cost principle says that that is the most objective, the cost, and that's what we put it up on the balance sheet. So when we purchase the building, we debit building for the cost of the building. Now, what do I mean by cost? Okay, that acquisition cost includes what you paid for the building, plus all normal and reasonable expenditures necessary to get the asset in place and then get it ready for its intended use. Okay, so some examples, cost of a factory machine include the invoice that we had to pay for it, less any discounts for early payment, plus shipping, unpacking, assembling, installing, and testing. Those are all normal and reasonable expenditures to get it ready for its intended use. Okay? To be recorded as part of the plant asset cost, it has to be normal and reasonable. Now, let's look at this. It says if an asset is damaged during unpacking, those repairs would be expense not added to the plant asset cost. So you can't include that in your debit to building up on the balance sheet. You can't include that in the building cost. These you can because they're normal and reasonable. This you can't. Why can't you include that? Well, is it normal and reasonable that we would expect the asset to be damaged during unpacking? I hope not, because then that's probably not a supplier that we want to deal with anymore, right? If we always expect that it's going to be damaged, we need to go to another supplier. So it's not normal and reasonable that we would expect it to be damaged during unpacking. So therefore, we can't include that in the cost of the building when we debit building. Okay. So let's look at the land. So let's look at some specific plant assets here. So with land, when purchased for a building site, when we talk about the cost of land, so when we debit land, right, we're talking about the purchase price of the land, plus any real estate, commissions, title, insurance fees, legal fees, any accrued property taxes. Those are all the normal and reasonable expenditures to get it ready for sale. Okay. Also, any payments for surveying, clearing, grading, government assessments, cost of removing existing structures. One thing about land, it's not depreciated. Land is not depreciated because it's assumed to have an indefinite life. Land improvements have a limited life, and therefore they are depreciated. And land improvements, such as putting in a sidewalk or a fence, driveway, those would be charged to a separate land improvement account, and then those would be depreciated. When we talk about the cost of a building, so we buy a new building, okay? What goes in the cost of the building up in the balance sheet? What cost do we debit buildings for? I mean, how much? What we bought it for? Plus any normal and reasonable expenditures to get it ready for its intended use, such as brokerage fees, taxes, title fees, attorney fees. Okay. Insurance costs, and I have a typo here. To cover the asset after it's placed in use are operating expenses. Those are not, when I say the word capitalized, that means the cost that's put up on the balance sheet, the debit to buildings. Okay. This cannot be included in your debit to buildings. It has to be recognized as an operating expense. It can't be capitalized. What that means is put up on the balance sheet. Okay. Machinery and equipment. So all normal and reasonable costs to purchase the equipment and get it ready for its intended use. Here's some examples: purchase price, taxes, transportation, insurance while in transit, installation and testing. Let's talk about lump sum purchases. So we say right over here, plant assets are sometimes purchased as a lump sum, okay, in a group price in a single transaction. Okay, so if we look at this example, it says CarMax, let me just let that adjust here, paid $90,000 cash to acquire a group of items consisting of land appraised at $30,000, land improvements appraised at $10,000, and then building appraised at $60,000. So this is how much is going to go up on the balance sheet total. But the problem is I used $90,000 to buy 3 different plant assets, and what I have to do is take this $90,000 and split it up between land improvements, and building. Now it's important that I do this, especially because land is not depreciated. So I have to put this $90,000, I have to say, okay, how much of this $90,000 goes to land? How much goes to land improvements? How much goes to building? How can I do that? I can do that based upon the appraised values. Okay, so I can use my appraised values to help me figure out how much of this $90,000 goes to each account. So what I do is I have my total appraised value right there, and then that's a percentage of the total. So 30,000 divided by 100 gives me the 30, 10, 10%. And then I multiply that times 90,000. So 30,000 times 90,000. 27,000 of the 90,000 goes to land. 9,000 of the 90,000 goes to land improvements. 4,000 of that, 54,000 of the 90,000 goes to building. And then that's how we would do that. So then what we would do here with our journal entry, debit land, 27,000, debit land improvements, 9,000, and then we would debit buildings for 54,000, and then credit to cash for 90,000. That would be our journal entry right there. And that's why it's important to separate those out so you can do your journal entry right. All right. So what I want you to do now is do this quick check problem here, number 3, number 82, and number 84. And I do want you to look at this. So it says 84. Let me just comment on this really quickly here. It says they paid $150,000 plus 6% commission. Okay. So when we look over here, I'm just going to do this for you really quick. It's $150,000. Okay. Because that commission times 6% commission on that 50,000, on that 150,000 plus 4,000. Okay. That's the cost. All right. So then use this table just like this to do this problem. Okay. So then go ahead and pause the lecture video, come back, and then we'll check it. Okay. Hello and welcome back. So let's look at these quick check problems and see how you did. So this first one, if land is purchased as a building site, the cost of removing and structures is not charged. That's false. That is normal and reasonable. Okay. To get it ready for its intended use. So it can be. It can be included in the debit to land up here. Okay. We look at this one, plant assets include all of these. All right, I'm going to stop the lecture video now and then start the next one on this problem. Thanks.